Welcome to the first episode of another brand new series here on the Duomo channel. Now, if you're a regular viewer, I'm sure you're probably thinking, wow, you're hitting us with series after series in 2020. Kind of like the Netflix of trading. And while I guess you could call us the Trade Flicks, and you're welcome for whoever decides to start that channel, it's for a good reason. Okay, we're bringing you these series because at the end of last year, when we reviewed our content, we realized that we were missing some things that some of you are really going to need. And one of those things is a series or more videos for beginner traders. You see, where our content was going, it was more like advanced stuff, or at least things where we assume people watching those videos probably know a fair bit about trading already. But the fact is, most people watching videos on YouTube about trading are probably just trying to get to terms with the basics. So what we're going to do, at the end of each week, we're going to have a new episode of this beginners trading series where we cover some of the basics. So this is not going to be stuff that's specific to the Duomo method. It's actually going to be stuff that applies to everyone. So these are the principles and foundations that you can apply regardless of what system or strategy or method you're going to be using, and it will hopefully set you on the right track. And if you do want to learn more about the Duomo method, then there's a link in the description box to our free course. It's about 2 or 3 hours and you can get to know about how I trade. So if you are a brand new beginner trader and you're going to be following along with this series, then leave me a comment below letting me know, introduce yourself, hit the thumbs up button, and let's get started. Alright guys, we're going to kick this series off with a lesson about something which I think is one of the most important and overlooked aspects of trading. Basically, one of the first things I look at when I'm approaching a new market. You see, the way that I look at trading is that it's kind of like golf, right? You've got this bag of golf clubs and you'll use different ones depending on the environment that you're in. So when you're teeing off, you're not going to use your putter, you'll use your driver. Or when you're putting, you're not going to use your wedge, you're going to use your putter, and so on and so on. And it's kind of like the markets. Whether you're using the Duomo method or something else, you're likely to have a range of different tools and concepts or indicators that you're going to be using to approach the market. And you'll learn all about those things in good time. But the first thing you need to be able to do is to read the context of the market to know which tool to use. You see, let me share with you a little trade secret. The worst traders out there are often the ones who use one approach for every different market type. If you think about how that applies to literally anything in the world, not just trading, you'd think it was ridiculous. You have to match what you're doing to the context that you're in. So this first lesson is the first step in being able to read the context of the charts, the price movements. So let's head over to the charts and we'll get stuck straight in. As a beginner trader, you might look at a price chart like this, and particularly with a candlestick chart, which is what this is, and think, well, it looks like a bit of a mess. I don't really know what it's telling me or what I can deduce from this, what kind of understanding I can get about the market from looking at this price chart. I can just tell that the price has moved around. And I kind of see it the same as learning a foreign language. So the first time you hear that foreign language spoken to you, it might just sound like a weird mix of different sounds, and you can't even pick out individual words, let alone make sense of what's being said. But over time, you start to learn particular words and how to construct sentences, and these act as reference points so that even if you're not actually at the stage where you can speak that language, you can at least pick out where the individual words are and maybe start to understand the context of what's being said. And that's the same with the markets. What you're going to learn in this lesson are some reference points that are going to help you to start constructing an understanding of what the markets are doing and how you can act on that. Now, in terms of what we're discussing here, there are, broadly speaking, two types of market. There's a trending market and there's a sideways market, which you'll often hear people refer to as a range or a ranging market. So a trending market simply means that the price is moving in one particular direction. It's having a sustained move in one particular direction. And I'm sure you can probably guess, a sideways market means that it's not going in one particular direction in a sustained move. So when it comes to the trending markets, we obviously have the trend when the price is moving up, and we have the trend when the price is moving down. So with the price moving up, we can refer to that as an uptrend, or it's also known as a bullish trend, because when things go up, it's the bull movement, and when it goes down, it's known as a downtrend or a bearish movement, because you have the bear moves. So you have the bulls and the bears going up, going down. So with this new information, we can obviously see that the price was in an uptrend here. It was a bullish trend. It was in a slight downtrend, bearish trend there. Again, it's heading up after that. And all of these things start to add to the context of the market. Because, for example, when it's trending upwards, that might encourage you to enter what we call long trades, which is where you're profiting from the price moving up. Or at the very least, you might not want to open short trades, which is where you're making a profit from the price moving down. Or at least you might be more cautious. Or you might want to see a sign that the trend is running out. So maybe you're going to wait for there to be a bit more of a sideways market, like you can see around here, that the price is sort of staying in this area, before then it's moving in this bearish trend down here. And maybe that's what you're waiting for, is that you're waiting for the bullish trend to show signs that it's run out before you're entering based on the bearish trend. Now, that's all well and good for looking at charts in hindsight and seeing what's happened historically. But if we want to act upon that information, we need to have certain techniques of being able to anticipate when a trend is starting or when a trend is ending, when we're in the middle of the trend, and so on. Now, a lot of this is going to depend on the specific method or system that you're using, because there are lots of different tools and indicators and concepts for figuring out when there's a trend starting, and a lot of them will be much quicker than what I'm about to teach you. And when I say quicker, I mean they're going to be more immediate. They're going to tell you when the trend's starting sooner than what we're about to go through. But that's sort of what provides different systems and methods their edge, because the sooner you can identify a trend, the sooner you can act on it, and the sooner you can make a profit from it. Now, with the Duomo method, we have our own ways of doing this, but what I'm going to teach you now is something that's very straightforward, it's very easy, and it's something that could work with any way of trading. And it's all about the price structure. So if you look at this chart here, as we're moving down, even though we can see it's in downtrend, there are still moments when the price moves in a bullish direction, moves up. Now these are called pullbacks, and it's because when the price is moving, it doesn't just move in one straight line like this, where it's just going from one price to another in a bearish trend. Instead, you can see what it does is moves in this sort of shape. Now, these are called oscillatory movements, but they're most commonly known as the waves in the market. So you can forget that long O word, you don't need to know that. These are the waves in the market, and it's these waves that allow us to identify the type of market we're seeing and to identify when that market is changing or continuing. So let's have a look at a diagram to make things easier. You can see we've got two different diagrams here. The one on the left is a bullish trend because the price starts off lower than it ends up at the end. So it ends up being higher, the price has moved up. And the one on the right hand side is a bearish trend. The price started higher and ended up being lower. Now you can see these waves that we just discussed, and with these waves we have a top of the wave, which we refer to as a peak, and we have the bottom of the wave, which we refer to as the trough. Now, different people have different names for these, so if you hear it being referred to as something else somewhere else, then don't be alarmed by that. But I think the easiest way to think of them, and a term that you'll hear referred to a lot, are highs and lows. So the peak is a high and the trough is a low. Now that's obviously on the bullish trend there, but if we look at the bearish trend, the terms are still exactly the same, even though the price is heading down. So the top of each wave is a peak or a high, and the low of each wave is a trough or a low. Now, when you look at the diagrams like this, it probably seems quite straightforward to see that one is a bull trend and one is a bear trend there. But there are some simple rules we can use that will apply to the real charts, so the candlestick charts like we just saw, and situations that are perhaps a little bit messier. And basically, the simple rule we can follow is that for a bull trend, we're going to see higher highs and higher lows. So what this means is if we think of these waves as the highs, then you can see that that second wave is higher than the first wave. So that's a higher high. And if we look at the next low in that trend, so we've had the first high, then we've had the first low, then we've just labeled that higher high, and we can see the next low is a higher low. So what we can say about a bull trend is that it's going to be characterized by higher highs and higher lows in terms of the waves. Now, can you think about what that means for the bear trend? Obviously, that means that we're going to have lower highs and lower lows. Each new high of the wave is lower than the previous high of the wave, and each low is lower than the previous low. So that, in simple terms, is how we define the bull and the bear trend in terms of the price structure and looking at the waves. So let's say that we are following this price live. We can see that we've got this low, and at this point we had a lower high than before, but then we created a higher low. So at this point, it's like a red flag. We think maybe things are changing here. So as we look at this previous high, we can see that the price pushes through there, and it's an indication that now we may be entering a bullish trend, or depending on how you want to look at it, it may be that we already are in a bullish trend. And you can see after that point, more or less, most of the time we're getting higher highs and higher lows up until this point here. At which point you can see we have the low here, then we have a lower high. So, okay, that's a red flag, maybe we're in a bearish move now. Then we get a lower low, lower high again, and it continues. So this is how we can look at the bullish trend and the bearish trend. But then what happens when we get to an area on the chart like this that you can see at the top there? So at this point we have the high, the low, we've got a lower high, now a higher low, lower high again, lower high, higher low there. It's all a bit mixed, and it's all kind of staying in the same area. So this is what we'd call a sideways market. This is what we discussed earlier, but in terms of the waves, this would be a sideways market. So let's have a look at a diagram. Think about the highs and the lows. So if we think about a sideways market, we're probably looking at something like this. So if we mark in the highs and the lows, we can see that sometimes the highs are higher, but sometimes the highs are lower. There's no consistency. So when there's no alignment in terms of the higher highs and higher lows, that they're a bit mixed like this, we will call that a sideways market. And that means we're going to approach things a little bit differently. With a sideways market, it tends to be that the highs and lows are going to be in similar areas, but they don't necessarily need to be exactly aligned. Like a lot of people are going to imagine a sideways market where it's sort of like this, where the price is fluctuating between these two boundaries. And that sometimes happens, but it's not always the case. Now earlier I said that a sideways market can also be referred to as a range or a ranging market. With the Duomo method, we refer to this as a sideways market when there's no clear direction, it's kind of staying in the same sort of area, and we're more precise about the use of the name range. And for us, a range is more when it's falling between these two levels, like this little picture that I've drawn here. So when it's between two clear boundaries, that would be more of a range. So if you look through the chart, you're going to be able to now identify the bullish and the bearish trends. And I'd like you to get yourself a drawing tool like the one that I'm using. My one is called Epic Pen. I think it's available for free online, but use any one that you want. And just spend some time going through the waves, mapping them out, trying to identify whether we're in an uptrend or downtrend, and also looking at if you were following the price live, at what point could you tell whether we were changing the type of market that we're in? What sort of decisions could you make about what the activity of the price is telling you here? Now you're going to get moments where you look at things like this, where there aren't any waves, it's just one big bullish move, and you think, well, where do I put like the top or bottom of this one? And in situations like this, you can kind of count it as part of one big wave. And the fact is that even though this is a very sharp move, if you look at the candles themselves, then you can see that the highs and lows of each candle is the equivalent of higher highs and higher lows. And that's quite interesting because if you think about it, the chart we're looking at here is a 1 hour chart, which means that each of these candles counts for 1 hour. But within those are going to be other time frames and other movements. So for example, if we're looking at, say, this move from here to here, on this time frame it looks like a steady move of bullish candles and no structure. But on, for example, a 5-minute chart or a 15-minute chart, it might be that there's a bit more structure. So when we're counting this as part of the bullish move, you can actually look at the candles themselves to see whether it's still in a bullish trend. Now, the problem with the financial markets is that nothing is ever completely black and white. So while you're mapping out these different trends, you're going to see moments where you're not quite sure which wave you should be mapping. Like, where does the wave start and end? And to a certain extent, you kind of have to use your own opinion with this. You have to use your initiative, because there's no exact way to determine whether something is a wave or not. However, there are also different size waves that make up more of the context of the market. For example, over here you could be looking at, say, these bigger waves that are like this, but at the same time you can see in between there are these smaller waves happening, and those also add to the context and our understanding of the market. But that's something we'll get to in a future episode of this series, when we start to look at the time horizons of these waves and how that affects the context and how we are going to be trading. But for now, try to map out these waves, get used to it, start thinking about what that says about the context of the market, think about the strength of a trend based on these movements and when that trend is maybe stalling out like we're seeing over here, and what sort of decision that could lead to in terms of how you're going to approach that market, and just start to try to build this story in your head. I like to think of the markets in terms of a story, because if you can think about it in that way, it can help you to process the information more and kind of think about what the next chapters are going to involve for the markets, and that's how you start profiting from it. Alright guys, I think that's enough with the charts for now. So as I said at the start of the video, if you are a new trader and you're going to be following this series, please do leave a comment down below and hit the thumbs up button so we know. Don't forget to subscribe to the channel so you don't miss out on the future ones. And also, if you want to know more about how I trade, there are two things you can do. The first is join our free introduction course. It's linked in the description box. And then also follow us on social media. In particular, right now, I'd recommend following us on Facebook, because at the time of recording this, on Tuesdays and Thursdays at 1 o'clock in the afternoon UK time, I'm doing a live stream where I break down the markets or talk about things, answer questions. And if you're a new trader, that could be really helpful, because there's nothing better than really diving into the markets and getting a practical sense of what's going on. So take everything you've learned today, do your practice activities, and I will see you in the next one. Thanks for watching. See you soon.